Hello, welcome to Capital Sensei. Today we're going to do a deep dive into one of the most popular and frankly, most controversial financial plans out there. The Total Money Makeover by Dave Ramsey. We'll break down his famous 7 baby steps. From building your first small emergency fund to paying off every last bit of debt, including your house. We'll explore how to invest for retirement and finally, how to build serious wealth and become outrageously generous. This is a complete roadmap for anyone feeling buried and wanting a way out. Whenever we can, we try to answer questions left in the comments. Personal finance is, well, personal, and everyone's journey is unique. So please, share your story, ask your questions, and engage with others down below. Creating a community where we can learn from each other's successes and struggles is incredibly valuable for everyone. All right, let's get into it. Before we even touch on the first step of Dave Ramsey's plan, we have to talk about the mindset. This is the foundation upon which everything else is built. If you get this part wrong, the steps won't work. Ramsey's core argument is that personal finance is about 80% behavior and only 20% head knowledge. You can know all the math, all the economic theories, but if your behavior with money is broken, you will stay broke. It's about a fundamental shift in how you view money, debt, and your own future. He calls this shift getting gazelle intense. Think about it. When a cheetah is chasing a gazelle, that gazelle isn't casually jogging or stopping to look at the scenery. It is running for its life. That is the kind of energy and focus he says you need to bring to getting out of debt. It means you're going to live differently than everyone else around you for a little while. You'll say no to dinners out, you'll cancel cable, you might even take on a second job delivering pizzas. It's a period of focused, temporary sacrifice for a lifetime of financial peace. The enemy in this whole narrative is debt. Ramsey doesn't see debt as a tool, as many financial gurus do. He sees it as a trap, a product that has been marketed to us so effectively that we believe it's normal. Think of debt like trying to swim against a strong current. You might kick and paddle with all your might, but the current is constantly pulling you back. You make very little forward progress. The interest payments are that current, always working against you, making the banks rich at your expense. So the entire plan is designed to first stop the bleeding, then methodically eliminate this enemy from your life, so you can finally start swimming with the current, not against it. That's where the famous 7 baby steps come in. They are a clear, sequential process. You do them in order, one at a time, without jumping ahead. Let's break down the first one. Baby step 1 is to save $1,000 as fast as you can for a starter emergency fund. Now, a lot of people, especially those in finance, will immediately scoff at this. $1,000? That barely covers a major car repair. And they are right. But they are missing the point. This isn't your main emergency fund. This is a buffer. It's a small wall between you and life's little emergencies. Its sole purpose is to keep you from going back into debt when something unexpected happens. Think of it like this. If your boat has a bunch of holes in it and is taking on water, what's the first thing you do? You don't start redesigning the engine room. You find the biggest, most immediate leak and you plug it. That's what this $1,000 is. It's the patch for the leak. The car battery dies, the kid breaks his arm, the washing machine gives up. Instead of whipping out a credit card, you use your little emergency fund. It protects the momentum you're about to build. You get this money by any means necessary. Sell stuff on Facebook Marketplace, work overtime, pause your retirement contributions temporarily. You need to get this done and get it done fast. Once you have your $1,000 buffer, you move on to baby step 2, which is the heart of the plan and the most controversial part. Pay off all debt except for your house using the debt snowball. Here's how it works. You list all of your debts: credit cards, car loans, student loans, medical bills, personal loans, everything, from the smallest balance to the largest balance. You ignore the interest rates for now. Yes, you heard that right. Ignore the interest rates. You continue to make the minimum required payments on all your debts. But with every extra penny you can squeeze out of your budget, you attack the smallest debt on your list with that Gazelle Intensity we talked about. You throw everything you have at it until it's gone. Then, you take the entire payment you were making on that now paid off debt and you roll it over, adding it to the minimum payment of the next smallest debt. This creates a snowball of money that gets bigger and bigger as it rolls downhill, knocking out debts one by one. Now, as an economist, I have to address the elephant in the room. Mathematically, this is not the optimal way to pay off debt. The optimal way, known as the debt avalanche, is to pay off the debt with the highest interest rate first. This will save you the most money in interest over time. There's no debating the math on that. So why on earth does Ramsey advocate for the snowball? Because he understands human psychology. Remember, it's 80% behavior. Imagine you have a $300 medical bill, a $2,000 credit card at 18%, and a $15,000 car loan at 7%. With the snowball, you attack that $300 bill first. You might knock it out in a month or two. When you do, you get a quick, powerful win. You've eliminated an entire creditor from your life. You feel a surge of motivation. You prove to yourself you can do this. That psychological boost is the fuel that keeps you going when you're staring down that giant car loan. The avalanche method might have you chipping away at the high-interest credit card for a year with nothing to show for it but a slightly smaller balance. For many, that's just too discouraging. The snowball is about momentum. So once that first debt is gone, you take its payment. Let's say it was $50 a month, plus all the extra money you were throwing at it, and you add it to the minimum payment for the $2,000 credit card. Suddenly, you're paying way more than the minimum, and you see that balance start to drop much faster. Once that's gone, you take the big combined payment and roll it onto the car loan. The snowball gets huge, and by the time you're attacking your largest debts, you have a massive amount of cash flow to throw at them each month. You start to see the finish line. This step can take a while, maybe 2 or 3 years for most people. It's a grind. This is where you're living on rice and beans, saying no to almost everything. You're not investing, you're not going on vacation. Your single, all-consuming focus is killing your debt. It's tough, but the freedom on the other side is worth the temporary pain. Once all your non-mortgage debt is gone, you've reached a massive milestone, and you move on to the next phase. Baby step 3 is to finish your emergency fund. Now that you're out of crisis mode, it's time to build a real safety net. You'll take that same intensity you used to pay off debt and channel it into saving. The goal here is to save 3 to 6 months worth of essential living expenses. This isn't 3 to 6 months of your income. It's what you would need to cover the 4 walls: food, utilities, shelter, and transportation if you lost your job. To calculate this, you need a budget. You need to know exactly what your bare-bones survival number is. Let's say your mortgage is $2,000. Your utilities are $300. You spend $600 on groceries and $200 on gas. Your bare-bones monthly nut is $3,100. So a 3-month emergency fund would be $9,300, and a 6-month fund would be $18,600. Which one should you choose? It depends on your situation. If you have a very stable job and multiple incomes in the household, 3 months might be fine. If you're a freelancer or work in a volatile industry, you'll want to lean towards 6 months. And where do you keep this money? The answer is simple: somewhere safe and accessible. A high-yield savings account is perfect for this. It's liquid, meaning you can get your hands on it immediately without penalties. It's safe because it's FDIC insured up to $250,000. The purpose of this money is not to make you rich. It is not an investment. Its purpose is to act as insurance. It protects you from life's major storms: a job loss, a medical crisis, a major home repair, so you don't have to raid your retirement accounts or go back into debt. It protects your entire financial future. Completing baby step 3 is a monumental achievement. At this point, you have no debt except for your mortgage, and you have a fully funded emergency fund that can weather almost any storm. You are now standing on a rock-solid financial foundation. The game completely changes. You are no longer playing defense, just trying to survive. Now you get to go on offense and start building serious, long-term wealth. This is where things get really exciting. And that brings us to baby step 4. Invest 15% of your gross household income for retirement. This is where you unleash the most powerful force in finance: compound interest. Albert Einstein supposedly called it the 8th wonder of the world. It's the concept of your money earning money. And then the money that your money earned also starts earning money. It's an exponential growth curve. Think of it like planting a tree. The first year, it's just a tiny sapling. For the next few years, you might not see much growth, but you keep watering it, you keep tending to it. Then, after 10, 20, 30 years, you look back and you have this massive, powerful oak tree providing shade and value. Your investments work the same way. The earlier you start and the more consistently you contribute, the bigger your financial tree will grow. Let's look at an example. If a 25-year-old invests $500 a month and earns an average annual return of 10%, by the time they are 65, they would have over $2.6 million. Now, if they wait just 10 years and start at age 35, investing that same $500 a month, they would end up with just under $1 million at 65. That 10-year delay cost them over $1.6 million. That is the staggering power of time and compound growth. That's why Ramsey is so insistent that you start this step as soon as you're out of debt and have your emergency fund. So, where do you put this 15%? Ramsey has a specific order of operations. First, if your employer offers a 401k or a similar retirement plan with a company match, you contribute up to the match. For example, if your company matches your contributions up to 5% of your salary, you absolutely must contribute that 5%. Not doing so is literally turning down free money. It's a 100% return on your investment, instantly. After you've secured the full company match, Ramsey recommends funding a Roth IRA. A Roth IRA is an individual retirement account where you contribute with after-tax dollars. The magic of the Roth is that all of your growth and all of your withdrawals in retirement are 100% tax-free. This is a huge advantage, especially if you believe tax rates will be higher in the future than they are today. You can contribute up to the annual limit in a Roth. If you've maxed out your Roth IRA and you still haven't reached your 15% goal, you then go back to your company's 401k and contribute more there until you hit that 15% mark of your gross income. The combination of the employer match, the tax-free growth of the Roth, and the consistent contributions will build a formidable retirement nest egg over time. Now, what should you invest in within these accounts? Ramsey keeps it pretty simple. He suggests good growth stock mutual funds with a long track record of solid performance. He typically recommends diversifying your investments across 4 types of funds: 25% in growth and income funds, which are large, stable U.S. companies like Apple or Johnson & Johnson. 25% in growth funds, which are slightly more aggressive, large U.S. companies. 25% in aggressive growth funds, which are smaller, more volatile companies with high growth potential. And finally, 25% in international funds, which invest in large companies outside of the United States. The idea here is simple: diversification. You're not trying to pick the one winning stock. You're spreading your money across hundreds or even thousands of different companies in different sectors and different parts of the world. It's the classic "don't put all your eggs in one basket" strategy. This approach balances your risk while still allowing you to capture the long-term growth of the stock market. You're not day trading or trying to time the market. You're playing the long game. With your retirement saving on autopilot, you can now move to baby step 5, save for your children's college education. This step only applies if you have children you want to help with college, of course. The key here is the order. Notice that retirement saving comes before college saving. This is a non-negotiable part of the plan. Why? Because you must secure your own oxygen mask first before assisting others. There are many ways to pay for college: scholarships, grants, work-study programs, and yes, student loans. But there are no loans for retirement. You can't walk into a bank at age 70 and get a retirement loan. If you sacrifice your retirement savings to pay for your kids' college, you risk becoming a financial burden on them in your old age. The greatest gift you can give your children is to be financially independent in your own retirement. For saving, Ramsey recommends using tax-advantaged education savings accounts. The two most common are the 529 plan and the Coverdell Education Savings Account, or ESA. Both of these accounts allow your investments to grow tax-deferred, and withdrawals are completely tax-free as long as the money is used for qualified education expenses like tuition, fees, books, and room and board. They are like a Roth IRA, but for education. You can open these accounts and begin contributing once you've started baby step 4. Next up is baby step 6, pay off your home early. This is the final boss battle in your war against debt. You're already investing 15% for retirement and saving for college if applicable. Now, you take any and all extra money you have and you throw it at your mortgage principal. The goal is to become completely 100% debt-free. Think about the psychological and financial power of this. Imagine having no house payment ever again. Your single largest monthly expense would vanish. What would you do with that extra $2,000, $3,000, or even $4,000 a month? The level of freedom and peace of mind that comes from owning your home outright is something most people can only dream of. It changes your entire financial picture. Let's look at the math. A $300,000 30-year mortgage and a 6% interest rate will have a monthly payment of about $1,800. Over the life of that loan, you will pay over $347,000 in interest alone. That's more than the original loan amount. But if you were to pay an extra $1,000 a month towards the principal, you would pay off that same mortgage in just over 13 years and save yourself more than $190,000 in interest. Paying off your mortgage early is like giving yourself a massive, guaranteed, tax-free return on your money. Once that final mortgage payment is made, you have a celebration. You've climbed the mountain. You're completely debt-free. You've reached a status that less than 10% of the population ever achieves. You won the game of personal finance, but there's one more step, and that brings us to the final step, baby step 7. Build wealth and give like no one else. This is the pinnacle. With no debt payments of any kind, Your income is entirely your own. You can now use your money to live the life you've always wanted and to make a significant impact on the world around you. The money that was once going to the mortgage company is now freed up. You can use it to supercharge your investments well beyond that initial 15%. You could invest in real estate, start a business, or simply build a massive portfolio of mutual funds. Your wealth will begin to grow at an incredible rate. You're no longer just comfortable. You're building a legacy. And a huge part of this step is the give part. Ramsey is a big proponent of generosity. He believes that the ultimate purpose of building wealth is not just to have a bigger house or a nicer car, but to be able to radically change the lives of others. With significant wealth, you can support your church, fund a charity you're passionate about, help family members in need, and leave a lasting inheritance. You can change your family tree for generations to come. This is where money stops being about you and starts being about the impact you can have. Now, as an economist and investor, it's my duty to provide some nuance and address the common criticisms of this plan. It's an incredibly effective system, but it's not without its critics, and some of their points are valid. First, as we discussed, there's the debt snowball versus the debt avalanche. The math is clear. The avalanche saves more money. If you are a hyper-disciplined, spreadsheet-loving person who is motivated purely by numbers, the avalanche method may be a better fit for you. But Ramsey's plan is designed for the masses who have struggled with debt because of behavior. And for them, the quick wins of the snowball are often more effective. Another criticism is the $1,000 starter emergency fund. In today's world, especially in a high cost of living city, $1,000 can feel dangerously low. A single major car repair could wipe that out and then some. I think it's reasonable to adjust this number based on your personal circumstances. Perhaps 1 month of essential expenses is a more appropriate goal for baby step 1. But the spirit of the step remains. It should be a small, achievable goal to build momentum, not a full-blown safety net. Then there's the issue of his investment return projections. Ramsey often uses an average annual return of 12% in his examples. Historically, the S&P 500 has returned closer to 10% per year before inflation. While a 12% return is certainly possible in some years, using it as a long-term planning assumption is optimistic. I would advise anyone running their own retirement calculations to use a more conservative number, perhaps 7 or 8%, to be on the safe side. This doesn't break the plan, but it manages expectations and encourages you to save even more diligently. Finally, there's the hardline stance on credit cards. Cut them up and never use them again. The counterargument is that responsible use of credit cards can offer valuable rewards, fraud protection, and can help you build a credit score, which is useful for things like getting a mortgage or even a job in some fields. However, you have to understand Ramsey's audience. He is talking to people who have consistently gotten into trouble with debt. For someone who has proven they can't handle credit, a credit card is like a recovering alcoholic keeping a six-pack in the fridge. For them, total abstinence is the safest and most effective path. In the end, the Total Money Makeover is not a get-rich-quick scheme. It is a methodical, disciplined, and sometimes grueling plan for people who are truly fed up with debt and want a proven path to financial freedom. It prioritizes behavior change and psychological wins over complex mathematical optimization, and for millions of people, that has been the key to their success. It's a clear roadmap that takes you from being buried in debt to a place of security, wealth, and generosity. The plan works. The only question is whether you are willing to work the plan.